watching Stock Watch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Nader from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. You're going to have to do all the heavy lifting today because my brain is still mushy. I just came out of, I really think this is COVID 2.0. Anyway, I was on leave the whole of last week. Anyway, I'm back and it's good to be back. Right, let's get straight to the questions. Lots of questions that the viewers have posted today. And let me actually start off with, I think, would be a $1 million question, but I don't know how simply you can answer this. What single stock or share would the panel recommend for the best dividend on the JSE 5 to 10 year view? Wouldn't that be something? JP, let me start off with you.
Wow, best dividend. Okay, so not necessarily total return, specifically dividends. Sure, if I think of companies that have got a high probability of paying large or special dividends, I would say Santam is one. And I would say AVI is another. Yeah, I think those two. Maybe Lewis is a third one, even though a big chunk of their cash will probably go into share buybacks, not just dividends. So those would be the three I would say one could look at for high dividends: Santam, AVI, Lewis.
So what are you basing this on in terms of like the earnings that they pay out in dividends?
Yes, the current level of dividends that they pay out relative to the current share price. So those three are trading at a relatively high dividend yield when taking into account possible special dividends that might also be payable.
These are very interesting ones. Definitely AVI, a lot of people have said, but Lewis is the first time that I'm, on your side, Grant, looking at big dividend payers.
I think, I think I agree with those. Lewis isn't one I would have suggested, but I'm not close enough to it, so that's interesting to me as well. I think British American Tobacco will be a payer, and possibly Rainet, which owns Pension Corp in the UK. I think those could be two that would probably pay you quite nicely in yield terms.
All right. With BAT, even now, because they did have an update, and obviously this is a stock that a lot of people call ex-growth. I don't know if that's still the term that people are using at this point. JP, would you be looking at BAT in terms of still being able to give up those levels of dividends, even with the current, I guess, environment that they are dealing with right now?
Yes, and I think you're quite right when it comes to the traditional cigarettes, that it's not a growth business, it's actually a slowly shrinking or dying business. So that is being offset by the new category products. So below the surface is a lot of moving parts of one part of the business shrinking and another one growing and offsetting the shrinkage. And while they do have, their debt levels are slightly higher than being comfortable, they did reiterate today that they do want to make a significant dent into their debt, and it won't just come from the cash that they generate. It will also come from potentially continuing to sell a stake in ITC, which is the more than 100-year stake they've held in a significant tobacco business in India, and they did that a couple of weeks ago. They sold $1 billion of ITC shares. So they'll probably continue selling ITC shares, paying off debt, generating good cash that won't grow very quickly, but they will then probably pay out a large chunk of that cash in dividends. So yes, it would still be on my radar.
Ex-growth, sunset industry, but actually quite interestingly, they said that in the US, they should be returning to revenue and profit growth in H1 of the next year or something like that, in that combustibles businesses. I don't know, Grant, would this be a significant, I guess, signal that part of the market is stabilizing or not?
Look, I think you need to look at it in the context of the new generation products that JP referred to. So I'm quite a fan of Philip Morris, which is far ahead on the new category products.
Okay.
So that's the tobacco pouches and the heated, non-combusting but heated tobacco, nicotine products, and the vapes, etc. And there is a runway for growth there. So Bats is behind the curve. They're quite slow. They have gone ex-growth, but there's going to be an inflection point, as we've seen with Philip Morris, where the new category products overtake. The rate of growth starts to become significant enough and the contribution enough so that actually at the margin the company starts to grow. So while I don't think that's happening, massively so in the next year or two, but I can see the path there. It's quite clear. The stock is still cheap relative to Philip Morris, and because that growth is not yet evident. But I think there is a clear path as to how that can play out. Not from combustibles, though.
Ah, okay. Well, as you're talking about that runway for growth in the new category, the new category, the vapes and the like, it seems that there's also a runway for growth for criminals. There's a lot of these companies now are warning about the
lots of fake products.
Yeah, exactly. So, yeah, no, criminals want a piece of everything. Anyway, let's go into copper. There's so much talk about copper. The chart looks toppish, if not due for correction. Tops are characterized by unjustified optimism. Is it rather not time to look somewhere else for value? Copper's been quite a big thing. Is the optimism still valid, the way you look at it, JP?
Venati, I have not exhibited any accuracy in forecasting metal prices before, and I don't think it's going to start exhibiting any skill right now. So I have no idea what copper is going to do next. One could look at the cost curve of copper and try to work out what percentage of the whole supply chain of copper mines is profitable versus loss-making, and therefore try to take that as some sensitivity to how supply could react to demand. Demand seems relatively strong because copper is the main metal used in electrification. And as we move to EV vehicles and renewable energy, we will probably use more copper. Those types of sources of energy is more copper intensive. So those seem all positive for copper. But then again, we are taking out tons and tons of copper out of the ground every day from this lovely earth we have. So I have no idea what the copper price is going to do. I'm sorry.
Yeah, and all the miners want a piece of it. And I mean, even a lot of the guys that choose the diversified miners as their picks, usually copper is what's really attractive there. Grant, your side, would you be finding value in copper, or would you be looking somewhere else for value?
I'm reasonably constructive on copper. I think the JP touched on the. I think what we also need to remember is all the old industries. When you're building typical infrastructure, there's a lot of copper involved, and all the new industry as well. All the high-tech factories they're building. They're trying to reindustrialize the US. They're trying to reshore, onshore, nearshore, friendshore, you name it. That all involves putting up new factories, high-tech manufacturing capability and industry. And China's also pushing hard into that space. All of that needs copper, whether it's a cell phone, whether it's a battery, there's copper involved. So, I think long-term, the structural demand things are in place and intact. Yes, there is quite a bit of copper around, but I don't think the supply is coming online as fast as the demand is growing. So I still think there's a constructive outlook for that.
Okay. Well, what about PGMs? There's a question here. 5-year view for Imbala, JP?
It's an interesting one. So if you look what's happening at the PGM space, we had a rhodium bubble about 3 years ago. Since then, rhodium, palladium, platinum have all collapsed, and more recently, platinum is showing some signs of life. But if you look at the PGM basket, the metal that has driven the super profits of the previous cycle was rhodium, not platinum and palladium. So even though we're seeing some life in one of the three, you actually need to see rhodium, getting into some type of spike again. And then the revenue and the profits of the companies will really start increasing like they did in the previous cycle. Now, it's rare to have two bubbles only a few years apart. So again, I have no idea what the metals are going to do, but I would think it is improbable that so soon after a previous PGM bubble, we're going to have another PGM bubble. So I'm also not exceedingly bullish about the metal. What I would say is a lot of these PGM stocks are trading at cheap levels. They have come back to almost like tangible NAV, the replacement cost of the mines, even below that. So if we have any optimism in the PGM price, the shares of the mines will do well. And they have done well the last 3 months, as we've seen this little bit of blip in platinum higher. So it's an asymmetric opportunity, but you need to have some positive surprise in the PGM metals for the mining shares to continue from these levels trading higher.
This is a long-term view, 5 years on Impala. Grant, how would you be shaping your view of Impala in the next 5 years?
So I wouldn't take a 5-year view on the PGMs or the precious metals because of the lack of visibility. I think you need to be active in the way you manage it and invest in it. But having said that, JP did highlight the risk reward. I think it is skewed to the upside. So I think with the cost curve is not far from where we are now. You'll start to see supply dropping off, and I think there's an underpin. So I think in 5 years' time you could have made a lot of money, or you could be exactly where you are now. So I don't think there's a lot of downside, but it's not that clear that you will be meaningfully better off 5 years from now. So, but along the journey there might be a decent opportunity. So that's why I say I'd be a little more proactive than putting it under the pillow for 5 years and hoping it works out in that time.
Okay. I did say that we'd be talking about Amplats, now Valterra. A comment goes, there must be a deeper reason for floating the division. The CEO says there are plans to go deeper at one of the flagship Mogalakwena mines. The new name is not a coincidence. And then they go on to say it's value tearing, value destroying. I don't know. Grant, it seems the viewer's not a fan of this kind of, demerger between Amplats and Anglo-American. What's your take on that?
Well, I mean, I think from Anglo's point of view, the demerger makes sense because they're trying to focus on those commodities, iron ore and copper, where there's a nice, clear path to profitability and it's a stable bet. And either that or BHP takes them out. So they had to do something. I think they were forced. The hand was forced. So if we look at Amplats as it stands, or Valterra, I think the spin-off will do them good. I think it'll refocus management. I don't think they've been doing a particularly good job the last couple of years relative to some of their peers. And maybe now they're going to step up to the plate. There is a history of spin-offs doing well. So now management has freedom. The balance sheet's been burdened a little bit. They paid a massive 16 billion rand dividend up to Anglo. So it was an amazing balance sheet. Now it's got a bit of debt, or at least they've offloaded the cash. So there's probably a limited return in the short term there. And their cost curve profile has been deteriorating a little bit, but they still have very good assets, and I think this focus for management, I think it will surprise you in the sector of the PGMs. I wouldn't say buy it over other resources or other commodities. Simply, if you're looking in that space, they might actually be a good entry point.
And it's actually taken quite a beating, in the last day or two. I think, when was it today? Down about 6%. JP, what are you making of this kind of new journey that Amplats / Valterra is on?
Yeah, so other than the fundamentals, we also have some technical factors in the short term. And when I say technical, I don't mean like the shape of the graph and how it wiggles around. What I mean is you now have shares being held by shareholders that were shareholders in a London-listed company, being Anglo-American, and all of a sudden they own shares in Valterra, and it's a fraction of their portfolio, and they say to themselves, why do I own this? It is a single commodity stock. It is focused on South Africa. I either need to take it up from a fractional holding in my fund to 2 or 3 or 4%, so that I can actually look at it with with some urgency,
Yeah.
or I must just sell it. And normally what happens is the fund managers just sell it. So that's called the blowback. It's shares that are handed to people who don't really want them, and then they all flog them in the market at the same time soon after they get them. We're seeing that dynamic in the short term. So it'll probably settle in the next few weeks. On the other hand, there'll be some ETFs, some index funds that all of a sudden would need to buy more Valterra because they track certain indices, and their weight in the indices will increase because the free float has increased, and they might not have held Anglo American, so they did not get Valterra shares, which means they need to go out in the market and buy the Valterra shares to rebalance in line of the index, which has changed. So that could also offset, from a technical factor perspective, the selling pressure we've seen already in Valterra. So I would say don't worry too much, or don't be dissuaded by the daily movements in the next few weeks. When the share has settled, it should be the fundamentals again from a month from now that drives the Valterra share price.
Yeah, very interesting points to note there. Well, gents, let's go into more questions. Please ask the panel about Growth Point. Grant, yeah, we haven't really spoken about property counters in a while. I don't know, would you say that they're steady at this point?
They are steady. The retail portfolio has been doing incredibly well. V&A, obviously a standout. Office has been very slow to recover, but they are seeing signs of stability and turnaround. So it probably warrants a closer look. And I think given, our view is that we are going to see more interest rate cuts, that the cycle is going to be extended probably out into next year. It might be prolonged, but extended at the same time. But still, there might be more cuts on the table over a longer period of time. And that's supportive of property stocks as well. So I think it looks reasonably attractive. It's not our preferred pick, but I don't think you can go too far wrong at these levels if you are looking at Growth Point.
Would you be flocking to Growth Point at this point, JP?
Not necessarily. I mean, all the local property stocks, as you say, have stabilized after they all got hit after COVID. And I would say when you have GDP growth very close to zero, even if rates are a little bit lower, I'm not excited about property stocks. You can look at some of the South African listed property stocks that have exposure offshore. They are a bit more interesting to me.
Okay.
But even there are issues. You can see Hyprop now getting involved with the mess at MAS PLC. So that's going to be interesting to see what's going to happen there. And then some of these South African property stocks, because they know, on an organic basis, not much is going to happen. They're looking at some corporate action, maybe some consolidation happening. So you see some shareholders picking up shares in SA Corporate, for instance. And I wouldn't be surprised in the next year or two, more of the local property stocks are saying, if we don't do something in terms of corporate action, M&A, our stock is just going to go sideways. So I think we're getting ready for quite a few deals, perhaps in the property sector in the next few years, if the GDP growth in our country stays close to zero.
All right. Let's get into 91. Your view, Grant?
I think it's a decent business, and I think what's been disappointing is their inability to grow their AUM. They've had outflows probably for the last 6 or 7 quarters, but I think that corner is turning because EM and the rest of the world is starting to perform relative to the US, and that will favor their fund flows. And so, in the meantime, you're getting market proxy. So these fund managers are a market proxy. Basically, you'll get market beta. You'll perform if the market goes up, they'll go up. And then you'll get a reasonable dividend yield and the potential for them to start growing their AUM again. They really are a distribution machine. I mean, they have more money than the PIC. I think their AUM is 3.5 trillion or something like that. So this is not a business to be sneezed at in terms of its capability and its distribution. So it's been disappointing, but I think it is still an opportunity at these levels.
Okay, interesting. I mean, yeah, a lot of people have actually, when I have asked about 91, there's always been just a sentiment of positivity and optimism. Would you say that this is just a continuing trend, JP?
Yes, I would say there's been realistic optimism, but in the short term, exactly like Grant has explained, because of these outflows, the share price has trended lower, call it last year or two. So I do think as these funds turn, the performance will turn, and the optimism, the realistic optimism, will probably find its way into the share price moving a bit higher again. So yes, you're getting paid to wait through the high dividend yield.
Yeah.
I don't think necessarily it's going to shoot the lights out, but if they can turn into net inflows from the net outflow situation, and you have markets helping them, the share could do well. A lot of stock market indices are a bit overextended though. So again, if we have a hiccup, who knows where the next bear market is going to come from and when it's going to hit? No one knows. But if that happens, again, 91 is also going to get hit. So for me, it's a share that if I see it in a portfolio, I wouldn't sell it, but also I wouldn't necessarily buy more. I'm lukewarm on 91 shares.
Well, talking about lukewarm, a lot of people have been lukewarm on Brait, complaining that it has done nothing for a number of years. Is Brait worth having a look at? The share has been going up in the last few weeks. If the panel can share their insights, I think on the day it's up almost 2.5%. But I mean, yeah, this is a share that a lot of people have said has gone nowhere. Grant?
It's one that has disappointed. I mean, it's not one we would invest in. But what I have seen, they have one decent asset, which is the Virgin, the gym, the gym business, let's call it, the health business. I don't think the rest of it is particularly good. I was disappointed when they spun off Premier, which was a great asset, or at least a percentage of that. That balance sheet fix, they raised a lot of capital. I thought that would have sorted that balance sheet out, and you would have seen some life from that business. But I mean, it's doubled over the last year, I think, looking at the share price, but it's only doubled to R2.25 from very low levels. So I don't see a clear path to unlocking value. I don't see a great story to be told here. So I, again, admittedly, I'm not very close to it, but it's not one that I'm drawn to at all.
Yeah. JP, what story are you seeing with Brait?
So I sort of stopped following the story about a year ago when they did that rights issue.
Yeah.
But I agree with Grant. I don't think this is the environment for companies with stretched balance sheets. You have also rates rising around the globe. I know we said we might see rate cuts in South Africa, but broadly speaking, especially in Western economies, long-term rates are going higher. And that will probably pull shorter-term rates higher as well. Maybe in the short term, there might be cuts if economies are soft, but longer term, it looks like we are going higher because for too long, long-term rates have been suppressed and have been too low. So if that is the case, stretched balance sheets is not where you want to be. And even after the capital raise and the rights issue and everything that Brait have done, they still have a stretched balance sheet. So not on the top of my list, no.
All right. Well, what is at the top of your list? Your stock picks for today, gents. Grant, what are you choosing?
So my stock pick, I have picked it a while ago, but I still think it offers value. It's TSMC, Taiwan Semiconductor. I think based on Microsoft, Google, Meta's results, what we see in China, what we've seen from Nvidia, very much the AI investment cycle is far from over. The demand for Nvidia's products and other products similarly continues to grow and is structural in nature. And of course, there is no Nvidia chip without TSMC. They are the ones who are making the cutting edge chips. They are the cheapest entry into the space, into the semiconductors at the most cutting edge. And they're trading at around 15 times next year's earnings. So for me, that remains a high quality cyclical play into the AI space. And that's my pick, TSMC.
All right. JP, where are you finding opportunity this evening?
I'm finding opportunity in a local share, HCI, Hoskin Consolidated Investments. I had a look. I also picked it a year ago, and it's down 17% over the past years in RT. So that just proves that my picks over a one-year basis are not good. But I'm sticking with HCI because I do like it for the long term. It's an investment holding company, good capital allocation by the people in charge, mostly Johnny Copland. And if you look at what they own a big slug of Tsogo Gaming. That's the one part of the business that did not do well over the past year. Physical casinos are under pressure relative to online gambling. They also have a coal business, which was the other negative detractor from performance over the past year. But then they have a few real gems. And one of the strongest performers the last year was Southern Sun, which is also separately listed, the hotel business. Then they have Deneb, they have Frontier Transport, they have eMedia, And then offshore, they own a large chunk of African Oil Corporation, which owns some gas rights on the southern South African coast. And they also own a big chunk of Impact Oil and Gas, which has got some oil fields off the coast of Namibia, which they de-risked in the last year. So if you add up all the assets, you can get to the current share price just by looking at the listed assets, which means you're getting the oil and gas exposure for free. Or if you put a value on the oil and gas assets, you can say that it's trading at a significant discount to its net asset value. Depending on your valuations, could be as much as 40 to 50% discount. So I like that. The main capital allocator is getting on in years. So who knows if HCI is going to be around in 5 years' time. So with good underlying assets, potential for value unlock, and some optionality in the oil and gas business, I'm sticking with HCI.
All right. Well, thank you so much for your time and for your analysis today, gents. Really, really appreciate it. That is all for tonight's Stock Watch. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Nader from Benguela Global Fund Managers. Up next, The Close. Stay watching.